Hello everyone, my name is Blaine Pearson and I'm a graduate instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to examine the different types of education vehicles that we can use to save for our clients' education goals. Now, when we think about education vehicles and the various types of vehicles that are available to fund a client's goal of college education, it's important to understand the concept of what an investment vehicle is before we dive into the various ones available for education. And the easiest way to think about that is to think about the vehicle itself as a bucket. And what this bucket will do is it will hold all of these investments that we will use to save for the client's goal of education. And so we can visualize this as the bucket is the vehicle which we will then put various mutual funds, ETFs, stocks, bonds, etc. into. And that will be our water. So the education vehicle is what everything is going to be held in. When we think about the various types of education vehicles, the most immediate that come to mind are the 529 plan account and the Coverdell account, more or less the 529 plan account. The IRA or the Roth IRA, both accounts can be used as vehicles to save for a client's education, and the UTMA and the UGMA accounts can be as well. The UTMA is the Uniform Transfers to Minor, and UGMA is Uniform Gift to Minors Act. Now, let's specifically go into the 529 plan account and the Coverdell account. There are quite a few differences between the account types, so we're just going to highlight a few of the main points. So 529 plan accounts, due to the recent tax law updates, now triumph the Coverdell accounts. In the past, Coverdell accounts were used mainly for their purpose of being able to pay for high school education in the event that the client had a goal of saving for that. And 529 plan accounts were specifically meant for universities. So now the 529 plan accounts can be used to save for high school education, which have pretty much ruled out Coverdell accounts and their uses. But there are still some floating around. Now, Coverdell accounts have these restrictions. The first restriction that's most important is all the assets must be out by the time the beneficiary reaches age 30. There must be no more than $2,000 a year that you can contribute to the Coverdell account. Otherwise, the Coverdell account pretty much acts like a 529 plan account. 529 plan accounts are very interesting and probably the most commonly used education savings vehicle. They are only limited by the state allowance in terms of how much you can contribute. Most states, it's usually in the $500,000 range. And the clients are also limited by their gift tax willingness, so how much are they willing to contribute, subject to any type of gift tax in the case of a grandparent situation or something of that nature. Now, when, and this applies to 529 plans and Coverdells, the assets are taken from the account for both Coverdells and 529 plans, if those assets are used for a qualified education expense, the earnings on those assets, right, so what the water or the investment returned, do not have capital gains tax associated with them or dividend income tax associated with them if they're used for a qualified education expense. Now, if they're not used, there are some penalties, including a 10% penalty on earnings. The earnings are also subject to ordinary income tax. One great thing about the 529 plans as well is that if the child does not end up going to school, the account owner can change the beneficiary to another child or to themselves, etc. And what that allows the account owner to do is have a tremendous amount of flexibility. The next set of accounts we're going to look at is IRA, or individual retirement accounts, and the Roth IRA. And what these accounts are is they are retirement vehicles, plain and simple. However, they are masked as college education vehicles, oftentimes for planning purposes, or at least for the reasons that we'll use these vehicles in constructing financial plans where education is a goal. So there are some restrictions here. There's a $5,500 contribution limit right now in 2018. There is a $1,000 catch-up if you're over the age of 50. Now this $5,500 does go up over time. It does adjust for inflation. The ability to contribute, there are some AGI limitations if you're covered by an employer-sponsored retirement plan. Now, every now and again, you'll run across a client who thinks that their child, Johnny, is going to be the next running back superstar for Texas Tech's football team. And it's really great because if they are and they do receive a scholarship, or if the child ends up not going to pursue education, post-secondary education, that money is in your retirement account, growing tax-free, and can be distributed tax-free with respect to the Roth IRA. So it's a way that if you can only fund one, and we're talking about an IRA, Roth IRA versus a 529 plan account, it may be behooving to go ahead and fund the Roth IRA account first in certain client situations. Now, the UTMA, UGMA, the Uniform Transfer to Minors, and the Uniform Gift to Minors are two very interesting accounts. They are technically both trust accounts. There is no funding limitation. You are constrained by just how much you're willing to pay for gift taxes. The child gains control of the assets. The UGMA, when the child turns 18, they have complete control of the assets. The UTMA is 21, and the way I like to remember this is think of UT, the T for UTMA, and the T in 21. So you can distinguish between the age that the child gains control. Now, the earnings and gains in these accounts are subject and taxed to the minor, and kiddie tax rules do apply. And the major downside of the UTMA and the UGMA is the assets in the account are counted as student assets, and what that actually does is prevents a good deal for scholarships as well as FAFSA purposes. So the UTMA and UGMA can be great estate planning tools and those kinds of things, and do have and they certainly are a tool in the toolbox, but there are a few downsides, such as child control and that they do get counted as a student asset. Again, this is Blaine Pearson, and in this video, we covered the various types of education vehicles that we can utilize to save for our clients' education goals.